Economists often reference jobless claims and the unemployment rate to gauge the health of the job market. But while these two numbers are frequently mentioned together, they actually capture very different aspects of employment trends. Jobless claims are a weekly count of people newly applying for unemployment benefits, a real-time snapshot of layoffs. This number is closely watched because it can quickly reveal shifts in the economy, such as sudden layoffs or company closures. When jobless claims are low, it means companies are holding on to workers, signaling stability and confidence in the business environment. It suggests that employers are not feeling pressure to cut staff, which is generally a positive sign for the economy. On the other hand, the unemployment rate is calculated monthly and measures the percentage of people actively seeking work but unable to find it. This figure is broader, capturing not just those who have recently lost jobs, but also people re-entering the workforce, such as parents returning after a break and new graduates looking for their first job. The unemployment rate can remain high, even if jobless claims are low, especially if more people are looking for work, or if it's taking longer for job seekers to find employment. It's important to remember that the unemployment rate includes a wide range of people: those laid off months ago, those just entering the job market, and even those coming out of retirement. To visualize this, think of the labor market as a bathtub. Jobless claims are like the faucet, representing the flow of newly unemployed people entering the system each week. The unemployment rate, meanwhile, is the water level in the tub, the total number of people currently unemployed, regardless of when they lost their jobs. If the faucet is barely dripping but the drain is clogged, meaning people aren't finding new jobs, the water level can still rise, even if layoffs are low. Normally, when jobless claims are low, the unemployment rate is steady or falling, reflecting a healthy job market where people are finding work. But when these indicators move in opposite directions, such as low jobless claims but a rising unemployment rate, it signals something unusual is happening, like more people entering the workforce or struggling to find jobs. That's exactly what's happening in the US as of December 2025, with the job market sending mixed signals that are puzzling economists and policymakers alike. Understanding this split is key to decoding today's economic puzzle and helps explain why headlines about the job market can sometimes seem contradictory. The latest data for the week ending November 29, 2025, shocked markets. Initial jobless claims dropped by 27,000 to 191,000, the lowest in over 3 years. Normally, this would signal a booming job market.
But the unemployment rate has been creeping up, reaching 4.4% in September. More people are looking for work and not finding it, even as layoffs remain rare.
This disconnect is highly unusual. In a healthy economy, low layoffs usually mean strong hiring. Now we see low layoffs but rising unemployment, suggesting hiring has slowed dramatically. For the Federal Reserve and businesses, this complicates decisions. Workers with jobs feel secure, but job seekers face a tough market. This paradox forces us to dig deeper into what's really happening in the labor market. The headline numbers don't tell the whole story. The timing of this jobless claims report, coming right in the middle of Thanksgiving week, adds a unique layer of complexity to interpreting the data. During major holidays, the normal flow of business is disrupted. Government offices close, fewer people file claims, and some claims are delayed until after the holiday. This means the numbers we see for this week might not reflect the true state of the job market. As a result, the data can swing wildly from one week to the next, making it difficult to spot real trends or sudden changes. These swings are often temporary, but they can cause confusion for anyone trying to understand what's really happening in the economy.
The true level of layoffs may actually be higher than what's reported this week, since many claims are likely to be processed in the following week. Economists often warn that holiday periods can mask underlying problems or improvements in the labor market, so it's important to look at the bigger picture.
That's why experts prefer to use the 4-week moving average, which helps smooth out these temporary bumps and gives a more accurate sense of the overall trend. By averaging out the data over a month, the moving average filters out the noise from holiday distortions and one-off events. While a single week's drop or spike might seem dramatic, the moving average provides a clearer, more reliable view of where the job market is actually heading. Even with these holiday-related distortions, jobless claims have remained historically low for several months, which would typically signal a strong labor market and steady employment. Normally, such low numbers would be a clear sign that businesses are holding on to workers, and that the job market is healthy. Yet, at the same time, the unemployment rate has been rising, which suggests that something unusual is happening beneath the surface. This contradiction, between persistently low layoffs and a rising unemployment rate, signals that we're not experiencing a typical economic cycle, and that the usual rules may not apply. It's a reminder that to truly understand what's happening, we need to look past the headlines and dig into the underlying trends and details. The real story is often hidden in the details, not in the headline numbers. And right now, those details are more puzzling than ever, challenging experts to rethink what the data is really telling us. Economists predicted 220,000 new jobless claims, but the actual number was just 191,000, a huge miss that caught many by surprise. This wasn't just a minor forecasting error. It was a clear sign that even the most seasoned experts can be blindsided by today's unpredictable economic landscape. This gap between expectations and reality highlights just how uncertain and volatile the current economy is. Even with advanced models and years of experience, experts are finding it harder than ever to read the signals.
Many experts expected more layoffs, especially after seeing weak private payroll data. But instead of cutting jobs, companies are holding on to their employees, defying the usual patterns we've seen in past downturns.
Businesses may be hoarding labor, remembering the hiring struggles and talent shortages of recent years. They know how hard it was to rebuild teams after the last wave of layoffs, so now they're more cautious about letting people go. This marks a real shift from the old playbook, where layoffs were often the first and fastest response to any sign of a slowdown. Now, for many companies, layoffs are a last resort. They're choosing to weather uncertainty with their teams intact, hoping to avoid the costly cycle of firing and rehiring. The surprise in the data is a wake-up call, showing that traditional economic models are struggling to keep up with the rapid changes in business behavior and the labor market. The economy is ultimately driven by human behavior, not just numbers on a spreadsheet. People's choices, fears, and hopes are shaping outcomes in ways that are hard to predict. Something fundamental has changed in how businesses manage their workforce. Flexibility, retention, and long-term thinking are now at the forefront. Old forecasting tools and methods may no longer fit this new reality. The rules are being rewritten, and the old formulas don't always apply. The labor market is being shaped by new forces: technology, remote work, shifting priorities, and experts are still catching up, trying to understand what comes next. The lesson? In today's world, expect the unexpected. The only certainty is that change is happening faster than ever, and even the experts are learning as they go. The puzzle layoffs are at historic lows, but unemployment is rising. Continuing claims, people on unemployment for more than a week, are elevated, near 1.94 million. This means people who lose jobs are staying unemployed longer.
It's harder to find new work, so the pool of unemployed grows even as layoffs shrink.
Hiring has slowed more than firing. Conflicting reports add to the confusion. ADP's payroll data showed job losses, while jobless claims suggest stability. For most workers, job security is high.
But for the unemployed, finding a job is tougher than ever. The market feels strong for some, bleak for others.
This dual reality defines the American economy in late 2025. The labor market is both secure and stagnant. It's a strange new normal. The November jobs report, delayed by a government shutdown, leaves policymakers in the dark.
Wall Street and the Fed must interpret conflicting signals without full data.
The Fed's upcoming meeting is split. Some governors want to cut rates to fight rising unemployment. Others worry about inflation and want to hold steady.
The low layoff numbers argue for patience, but weak hiring data suggests action is needed.
The lack of clear data makes the Fed's decision a gamble. Their choice will shape the economy's direction. Hold rates high and hiring could slow further. Cut rates and inflation could return. The Fed is walking a tightrope and the stakes are high. The delayed jobs report means the next move is based on guesswork. The whole economy is watching. The outcome is far from certain. The pressure is on.
Economists call this the no-fire, no-hire market. Businesses are reluctant to lay off workers, but also hesitant to hire.
Job security is high for those employed, but opportunities for job seekers are scarce.
Companies remember past labor shortages and don't want to risk losing talent. But uncertainty makes them cautious about expanding.
The result is a stagnant market with little movement. Few layoffs, few new hires.
Unlike a recession, layoffs aren't spiking. Unlike a boom, hiring isn't surging.
It's a state of paralysis, especially tough for small businesses and job changers.
If you have a job, you're likely safe. If you're looking, it's a tough climb. The market feels frozen. Everyone is staying put.
The music has stopped and no one's changing seats. This is the new reality. The no-fire, no-hire market is driven by deeper forces.
First, reduced immigration has shrunk the labor pool, making businesses hold on to workers.
Second, AI and automation are reducing demand for some jobs, especially entry-level roles. Companies are meeting needs with technology, not new hires.
Third, trade policy uncertainty makes businesses cautious. Tariffs and disputes stall hiring and investment.
These forces combine to create a stagnant labor market. Businesses are reluctant to fire due to fewer workers, and reluctant to hire due to tech and policy risks. This isn't a normal downturn, it's a structural shift. The relationship between employers, employees, and the economy is being rewritten. Quick fixes won't solve it. The labor market is being fundamentally reshaped. The future will look very different. What does this mean for everyday Americans? If you have a job, you're more secure than ever, but mobility is limited.
For job seekers, patience and persistence are essential. Opportunities are scarce.
Businesses are stuck in survival mode, not growth mode. Small businesses feel the squeeze most, lacking resources to weather stagnation.
The economy is treading water, stable, but not moving forward.
A dynamic labor market is key to growth, but today's stagnation blocks progress. The low layoff rate prevents recession pain, but the lack of hiring stifles recovery.
The Jobless Claims Report is a symbol of an economy at a crossroads. Workers must adapt, businesses must strategize, and policymakers must provide clarity.
The Great Resignation has ended. The Great Stagnation has begun. How we respond will shape the years ahead. The story of the American workforce is being rewritten right now.